Today, I'm going to give you some really practical advice as to a deal that you can buy today and the deal that I think everybody should really be considering as possibly the best deal to buy right before this sort of market turmoil that's happening. Kevin calls it a crash. Is it really just an adjustment? What is it? Oh, and by the way, this video is going to be a one take because I'm heading over to Germany in like 25 minutes, so I gotta get this recorded and uploaded before the 25 minutes elapse. So here we go. Oh, and also, a one take means there won't be any kind of funny edits, unfortunately. So I guess that means I'll be boring. But you know those funny edits people make when they like snap and then something different, something changes? Well, we can still do that. Here we go. Huh? That was pretty good, huh? All right, let's get right into it. So here's what I'm recommending, folks. There are clear indications that, yes, we might be looking at a slowdown, an adjustment, a crash. I don't really care what you call it. I think prices are going to go down somewhere between 7 to 9%. I actually think in some areas, a lot of those price reductions have already been realized, especially in areas with, price sensitivities. So what I'm trying to say is you want, if you are going to buy right now or are trying to allocate money, you want something that is going to be resilient. So what I'm recommending is something like a condo or townhouse. Now, I know immediately I'm going to be getting folks that say, whoa, wait a minute. Did you say condo or townhouse HOA dues? No. I do not do associations. Okay, this is ridiculous. Why I say condo or townhouse is this. A condo or townhouse is an excellent opportunity for somebody that's getting started in real estate investing or somebody who's already a seasoned real estate investor that might want to try to mitigate some risk. Now, obviously, I can't guarantee that this is a risk mitigation strategy, but I think most condos and townhouses tend to sell in the below the median price range. That doesn't mean you can't have luxury townhouses or condos, but what I'm recommending is if your median, like in Ventura County, is $600,000 for a single family, I'm recommending look into the $250,000 to $300,000 price range. In that price range, you can generally find 2-bedroom, 1-bath townhouses. And again, every association is different. So if you're looking at something that has an association, you really want to verify to make sure that the association you're looking at is somewhat similar to what I'm talking about. But what I'm talking about is, in these associations, they cover the roof, the exterior painting, the doors, the garages, the streets, and historically, they have been financially sound enough to not have to create assessments where they bill the owners. That is, they have enough money in their association coffers, their reserves, to cover repairs, maintenance, and management that sort of arises from the day-to-day use of these association complexes or condos. So now you're in a situation where, now you have to fit in a cash flow analysis where you go, well, wait a minute. If I finance a townhouse, now I'm looking at my PITI, my principal, interest, property taxes, and insurance, plus association dues. Kevin, are these numbers really going to line up right now? Well, folks, look at it this way. Even Graham Stephan made a video saying it's really hard to find a cash flowing deal today at 25% down. That's kind of sad because back in 2011, and obviously that was the pit of the market, you could put 25% down and then borrow the 25% on like a home equity line of credit and then make both of the payments and still have a cash flow on the property you were buying. Obviously, I am not one of those people that only looks in the rearview mirror and says, well, should have bought then. Obviously, we all know that. But what I am suggesting is if we can find something that cash flows today with 25% down, maybe that's something we might consider for a few different reasons. Number one, Because the price point is lower and because of the changes in interest rates, I think the market has kind of shifted a little bit slower. I think now we could really try to procure a deal on properties in this price range. And I think rents will be proportionately higher because even though prices might adjust downwards a little bit, I think rents tend to stay higher because they're not inflated by low interest rates in the first place. Interest rates and rents don't really have anything to do with each other. So if rents go up and housing prices go up, but interest rates go up in the sale economy and then sale prices go down, that's not a variable that affects rent, so it doesn't matter. My take, obviously, it could be wrong. So I'm not predicting rents to decline significantly in this sort of adjustment, so to speak, being completely politically correct here, not calling it a crash, since every time I call it a crash, people seem to go, bloop, 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 bloop. You see what I'm doing there? These are all the YouTube comments that people go, this is not a crash, this is not a crash, this is not a crash. Anyway, all this lack of editing is really kind of changing the way I have to deliver this message. So, now you're looking at townhouses and condos below the median. You're ideally looking for townhouses and condos where the structure is covered by an association that really caters to landlords, where they're okay with people renting the property. Very important to make sure there aren't rental restrictions. And they do a good job at maintaining things like the roof and the building and structure and so on and so forth. Sometimes these associations will even cover earthquake damage via earthquake insurance policies. Now, obviously, I always recommend verifying all of these things. And in fact, I'll give you a quick little list if you're ever considering a townhouse or a condo. To me, the most important questions to ask are: 1, any lawsuits? Number 2, what is the ratio of homeowners to tenants? Generally, you want there to be less than 50% tenants. After 50%, financing starts getting a little bit more difficult if you're an investor. In fact, you might not be able to get financing at all. Then you want to find out, are things like termite damage covered? Which termite company do they use? Do they have termite service where they actually come out and spray regularly as preventative maintenance? You also obviously want to find out what amenities are included in the association dues. Sometimes you have $300 association dues and it's like, oh my gosh, $300 in monthly association dues. Yeah, but then they cover water, trash, and all this building maintenance, which now you are not obligated to pay, which is great. So there are a lot of benefits to an association. Obviously, there are a lot of downsides as well. You have to follow rules. If you're living there, sometimes it's a little bit more of a headache. But we'll do a specific numbers example here as well in just a second. The last little point I wanted to make is oftentimes these condos and townhouses are a great opportunity for somebody who is just getting in, a first-time home buyer, because look at it this way. If you find a fixer-upper townhouse or condo that's in the wedge of the market, remember my wedge video? Go check it out. I might be able to put the little button here so you can click on the wedge video, since I can do that later while I'm at the airport. But what you want to look at is, okay, if I could find a wedge condo, now it's 900 square feet. Well, what do I have to repair? Just the inside. Just have to deal with the paint, the flooring, the appliances, the toilets, the bathroom vanities, the light fixtures, the switches, the outlets, and you've gotten pretty far. Now, if you have a house, you usually have to deal with the roof, the outside, the landscaping, the driveway. There's so much more. You could go into a little 900 square foot condo with $10,000 and do a significant wedge improvement or just overall improvement in the condition. Whereas a house, I don't recommend touching a house for under a $50,000 budget. And that's a budget, so to speak. So let's do an actual numbers example here. If you buy one of these townhouses, obviously every area is different. So look, I know a $600,000 median price point, that's high, but again, that's Southern California. I'm just trying to make it relative to my area because these are the numbers I can internalize pretty dang well. So just scale them for your area, whatever area that might be. If you buy a $264,000 condo and the association dues are, say, $300. Now, let's put aside $100 for management and $200 for vacancy, repairs, and so on, which honestly, $2,400 a year for vacancy and repairs on a little condo like this is really high, but I'd rather be conservative. And you put 25% down. you would be looking at a loan of $198,000. Principal, interest, tax, insurance payments, management, reserves, and vacancy factor. All in of about $1,614. Now, I'd love to break this all apart. I'm pretty sure principal and interest was like $990, plus the $300 for the HOA, then the management, vacancy, reserves, and so on and so forth. I kind of rounded it all to about 16, 15, somewhere around there. You look at then, what can this property rent for? And the property can rent for $1,900. So this means you put 25% down and you actually have a cash flow of somewhere around $275 per month, maybe $285 per month. Now all of a sudden, you got yourself a 4 to 5 cap if you wanted to, do a little return on investment calculation. Now, it's not exactly how you calculate cap rate, just in case you want to know. Usually when you calculate cap rate, what you do is you take the property's income, say apartment complex income of $100,000 a year, you take an expense ratio of, say, 35%. Great, now I got a $65,000 net operating income, and you sort of divide that into the purchase price of, say, that apartment building. Say it's $1 million. Now you got a 6.5 cap rate. That's the actual cap rate. I sometimes, this is just a personal thing I do in my head, I sometimes consider cap rate my IRR is the correct phrase. It's not the right way to do it, but IRR is called an internal rate of return. It's basically saying, wow, if I can get a cash-on-cash return of, say, 4 to 5% on one of these condos, and I'm paying my debt service, my principal and interest, again, not exactly the right way to calculate it, it's just the way I do it sometimes, that's not a bad deal to me. So now I'm getting principal pay down, now I'm getting appreciation. So all in all, what I'm trying to say is, consider buying something below the median. Consider buying a condo or townhouse in this market, because last little takeaway of all of this, when interest rates rise, the lower price point usually isn't as affected anyway. So you might be able to find yourself an amazing deal over there. Thanks for watching, folks. More special effects. Nothing happened. See you, folks.